taking an unconventional look at stocks, property, bonds, economics, and more. This is the Total Money Management Podcast with Steve Moriarty, Tom Hill, and Jacob Senior.
Welcome to Total Money Management. We're back, the three of us again. How you going, gents?
Good, mate.
Very
Good.
well.
I'm a bit cold today. I'm not sure.
That's because the air conditioner's on.
The air conditioner's freezing. Look, this week's going to be a little bit different. We're going to spend a little bit of time on the man himself, Warren Buffett. He's made some quite drastic changes to his portfolio over the last few weeks, and we just wanted to, when Buffett makes changes, it's worth listening to. It's worth just looking at, evaluating, seeing where he's at, seeing where his positions are at, and how does that, and kind of relating that to how we invest and how we teach people how to invest as well. So we might spend a bit of time on that to start with, but like the big issue being CAPE at 35 in the US. Which
Indeed.
It's been up there for a while now. But then relating that into Buffett's latest change, which is he's sold off, 100 billion or something?
A couple of bucks.
Yeah, just 50% of his Apple holdings, which was his largest holding, right?
How was your day, darling? Yeah, good. I made 100 billion. Oh, that's good, darling. Steak and Coke? Yes, thanks.
Well, it kind of, in my mind, it relates to this sense of global decoupling and countries kind of looking after their own. Lower Apple sales in China.
Yep.
Which means that Apple's expected growth in in that country, and therefore other countries are expected to be lower. That's one point of what Buffett will be looking at, and what Berkshire Hathaway, it's not just Buffett, it's his analysts as well, will be looking at and going, you know what, this might not, we've held Apple for
about 10 years, 2014 I think he bought.
10 years, there's general 10 years.
There's probably a tax thing too. Knowing Buffett, there'll be you get less tax.
Oh, there'll be 100 reasons, right?
Yeah.
He's made a lot of money. Apple can now sell less products because China don't want them as much.
Yep.
The market as a whole's very overvalued.
Yep.
We know he's a value investor.
Yeah.
Blah, blah.
So he started to sell down, which is what we've been talking about for a long time now. And when you start to see these things converge and happen at a similar time, it makes you think. So the first point I wanted to talk about, gents, is that he's lowered, he's kind of sold off most of his portfolio. Is there anything? Actually, we've got a chart up here, which is the man with the.
There's Uncle Warren in a golf cart. We've innovated here on the podcast. We've now got pictures, right?
So look,
talking pictures.
What are your thoughts, Tom, Steve, on that?
Tom?
Well, I think the market right now is very expensive, and if one of the most successful investors of our time thinks it's a good idea to be holding lots and lots of cash,
there might be something in
I'm
that.
interested.
There might be something in there.
Look, there's this theory that no one except for Buffett knows why, and I mean, I call bullshit on that. Like
it could, yeah. I mean, he could be. Look, I think if someone said, if you look at it, there's heaps of speculation about why Buffett did it. There's one person who knows why they did it.
Yeah.
Right? And that's Warren Buffett. Right? And maybe a couple of his, excuse me, a couple of his
senior
staff.
people.
Yeah. So, but there's it doesn't hurt to go through the reasons why, because as you guys have just said, well, there's a few reasons, and he might say, well, look, exactly what we've said. Oh, China's going downhill. The PE's really high. Growth's not going to kick in that much as it has. The market's really expensive.
Well, he looks,
and he says, and I've made an absolute ton of money, and I'll take it off the table.
I've made them and look, if anyone can look at investments really objectively, it's Buffett.
Yeah,
and there are so many factors to say that being heavily exposed in one particular stock is not the right thing to do right now.
It's a bit risky.
It's a little bit risky, and so sometimes the story doesn't have to be amazing and
it can just be common sense. I made a lot of money and I decided to sell. Why now? Well, don't know. Made a lot of money and it makes common sense.
But let's be clear, he still holds an absolute ton of Apple shares.
Yeah. It's not like he sold a whole lot.
No. But he's spoken in the past, and I still remember you telling us about this. everyone talks about Buffett investing in Coke really early. He made an absolute fortune. But he's also publicly said he regretted not selling at
when
a PE
Coke
of
was
50.
regardless
of, how much money he had made.
Yeah.
So in my mind,
point.
it's probably just a simple fact that he's made a ton of money. The market's really expensive. He's expecting returns to be not as good as they have been for the last period of time.
Yep.
And it's just part of a rebalancing strategy. Why don't I load up on some more cash if I don't think that these stocks are going to perform that well anyway? They might.
Yeah.
I've still got a lot of them if they do.
Yeah, it's still going to be a big part of his portfolio.
100%.
Well, that point's exactly right. Like Buffett rebalances, and people don't actually acknowledge that. He holds for a relatively long time, but he does use the concept of rebalancing.
Absolutely.
He doesn't just hold forever.
He takes the cream off, and
Yeah.
if it drops, he can buy some more.
Yep.
Yeah.
And then he's bought his average price down.
Yep.
And
But
he'll
what-
make some more again on the next run up.
What you said before, Tom, is, Buffett learned from Coca-Cola that he really sort of sold when Coke was at a PE of 50, right? Well, Apple's at a PE of 33. That's double the average. So what you've got to do as a fundamentalist is say, will Apple's growth be double the average? If you go, no, it's not, then you have to say, okay, maybe it's overvalued currently, roughly at a PE of 33.
Not if they're not selling anything in China anymore.
That's exactly right. Right, so they've got big costs coming up if they're going to move out of China into India. Right, so there's a big chunk out of profit. Okay, what else? Okay, well, Chinese, as we discussed last week, are not buying Apple. Okay, so there's that going on, right? And that's where Buffett's the master. He's the master at looking at that stuff and going, okay, the growth rate's going to be 5%, not 10. The PE says it's going to be 10. Righto, well, it's actually going to be 5. It's time I sold some stock.
Just de-risking, reducing his exposure.
Absolutely.
And putting himself in a position that if, the theory's right and the market still works fundamentally off valuation long term,
Yep.
then he's going to be in a great position. With, what's that?
How much? 200, 100 and...
Oh, he's only sitting on a couple $100 billion cash.
Almost $200 billion worth of...
It's two in Australian dollars. I think it's 277 or something.
Yeah, so that's
billion
cash equivalents and short-term treasuries. When he now holds more bonds than the Fed.
Yeah.
As of, what date is it? 10th or 11th of August now. It's outrageous.
That's a lot of money. It's just a lot of money.
Yeah.
There's I think he took out 100 billion or something. And when he's got 277 billion Australian in cash. That's bigger than 490 companies on the S&P 500, right? So this is why he said years ago, the things that I can invest in are really quite limited because he can't buy a $20 billion company. Why? Because it doesn't move the needle. Right? Even if he said, I've got 10% per year, it's like, well, okay, that's another couple of 100 million.
Yeah, it might make 0.5% on my portfolio.
Yeah.
It's outrageous.
It's crazy, but he's just a phenomenal person to, you've got to look at it. The old bastard's basically done it single-handedly.
Yeah.
It's just insane when you look at it. And he could have been twice as wealthy if he'd have paid himself like Elon Musk pays himself. Trigger all the Insta boys. There you go.
Don't talk about Elon.
Righto, stay away from Elon.
You're not allowed to call him a moron.
Oh, yeah. God.
Well, at the end of the day, and we've spoken about this before, he's a Kelly growth investor, right? So if he's dealt an ace, he goes big. And, if he gets a 3 and a 4, well.
He grows. His aim is to grow capital. That's right. That's right. That's what he says. He says, my aim is to increase the value of Berkshire Hathaway. And that the Kelly criterion, which we also teach people, is that's the way you grow your capital. So when you hear the finance industry go, oh, you want to use the efficient market theory to grow your capital, it's like bullshit. You want to use the Kelly criterion. Right? And that's what Warren Buffett does. And what does Warren Buffett do? The market's cheap. I'm going to put in a bucket load of money. That's what Kelly does. The financial theory people go, oh, yeah, just do your dollar cost averaging. Okay, well, that's fine. You might end up with more money, but you're not going to end up anywhere near like Warren Buffett. And Charlie Munger says the same thing. When it's, and Buffett's saying, right, when it's raining stocks, when it's raining cheap, reach for a bucket, not a thimble. Right? And it's really, like, as I say, you look at it.
Right.
Well, you look at it and say, well, when the Cape ratio is really cheap, it's a really good time to put in a lot of money. Right? But most people don't know that. And so the financial advisor's just going, oh, well, just put in $100 a week. It's like, dude, go and borrow and put in some money when it's really cheap.
Is it interesting?
But Steve, it can take a long time for the Cape to drop. That's boring. People want to make money now.
Well, I know.
That's just a big part of it.
To add on to that, I was having a conversation with a bloke last week who was like, the Cape's old, doesn't work anymore.
Oh, God. How many times have I heard that one?
Because it's been overvalued for so long. And I said, well, that's actually the point. It's been overvalued for so long, you've forgotten that it can be undervalued.
Well, it gets back to what you said, Tom, which is everybody wants to get rich in 5 years. Right? Nobody wants to spend the time and the effort and the knowledge. Well, people do, but most people think that, I want to get rich in 5 years.
Well, everyone wants to get rich in 5 years. That would be lovely.
But that's part of the bull market mentality too.
Yeah.
Oh, God, everyone's making money in property. I've got to bloody buy a property. Why? Because look at them. They're all getting rich in 5 years. And it's like, okay, but they did that because they bought a long time ago. Right, so you see this a lot where young people criticise older people, and some of it's valid. But what I'm also trying to point out to them is, dude, they bought the property in 1970, right? It's 2024, so they've made money just by hanging on to the property. It's not like they bought in 1970 and went, you know what, I'm going to be rich when I'm 65, right? But a lot of young people these days are saying, well, how do I get rich really quick? And it's like, okay, well, head off to the casino. But don't be surprised if you lose a lot of money, right? And that's sort of the way it really works. Right, but you get flooded with all these stories about the Domino's pizza boy with 10 properties, or, I bought 2 Bitcoin, or, I bought Nvidia at $1.10. All of these stories, which makes you think you can do it. And what I'm saying is you can, but boy, oh boy, that's 95% luck.
Well, you don't really hear about the people that have bought Bitcoin at 70,000 and now they're not at the poker table anymore. They've lost their money.
Yeah, well, they're on Reddit going, this is a scam.
Yeah. Well, it's something Buffett, you can tell, is obviously an old guard, is urging buybacks of shares and then selling into it. Well, I mean, what a legend.
But you can only do that if you're Warren Buffett. It's not going to work if I pick up the phone to Rio and go, hey, by the way, you should really think about buying some shares. Yeah. Oh, by the way, I have some.
Yeah. Buffett does it with
selling into that liquidity. It's like gold.
Yeah. I mean, honestly, buy back shares. Yeah, make sure you buy back mine at a 10% premium. I mean, what a classic. I must admit, though, he's also selling... And there's a couple of big sides. He's also sold some Bank of America, which is what he made an absolute bucket on. And I did too, quite frankly. And
just a thimble-sized bucket.
Yeah, thimble-sized bucket compared to the, D9 end loader he was using. And he also sold BYD, which is the Chinese EV car maker that Charlie Munger actually spotted. And I remember this because I remember thinking, oh, man, I should buy some of that, because it was on the Hong Kong Stock Exchange, and I think it was like $8 or something, right? And I never did. But I thought to myself, oh, well, if Buffett's bought it, it's probably got to be worth a look. Anyway, I didn't. The bloody thing's gone gangbusters.
Yeah, I didn't even know he held that.
Yeah.
Has he sold a lot? Or?
He's held that for a while, and that's why it's a bit like ding 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 ding. It's not just Apple he's selling, he sold the ones that have made a lot of money, and that to me is a bit like, okay, that's cashing in. And that's why we're saying, the big issue, it's Caper 35 tech stocks. You start to sort of go, this is why you rebalance.
Well, last week too we spoke about the fact that corporations are offloading shares fast, at a higher rate than they have for a very long time. So if you look at this, there's a massive confluence of events here. Overvalued. I feel like there's a war going on absolutely everywhere.
Yep.
Buffett's, has holding more cash than he has for a very, very long time.
Yep. Insiders are selling.
Exactly right.
Yeah.
So someone knows something that we don't. You know?
Well, that the innocent don't know, right? And it's. I think a month or so ago, might have been not July, June newsletter. We put in some stuff there about public holdings of stocks, right? And when it gets high with retail investors, you know it's the top, right? Because as I said before, it's the people who have never talked about stocks who go, everyone's buying stocks and making money. Oh, it's probably time I got in and bought some stocks, right? And it's so easy. You just open an account and buy stocks and they go up. Oh, that's cool. That's when you go, uh-oh, the people who don't know what they're doing are in the pool, right? And it's an indicator, right? Because the people who are not interested, it comes across their radar and they go, gee, bloody Tom and Jacob bought stocks and they're doing really well. I should buy some stocks. And you get in and, of course, next minute Warren Buffett's selling down half of his Apple stake and you're going, oh, that's interesting. I wonder why he's doing that. It's like ding, 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 ding.
Yeah, we bought them ages ago, and if you're buying stocks now, you're probably buying our stocks that we're selling.
Mate, you're buying Warren Buffett's Apple stocks, right? Okay. He's selling them to you.
Are you getting a call from Mr. Margin?
Yes. Anyway, what else have we got, gents?
On Monday and Tuesday, we've got the Australian average loan size for unoccupied dwellings is now rose by 1.7%.
Beautiful.
A record high.
That's it, folks. Keep borrowing.
Which is up 9.7% compared to a year ago. That's a
lovely
huge increase. But as well as that, and for those that can see the on hold thing on here, the RBA have changed the rates at 4.35.
Yeah, so, well, they held. Yeah.
Sorry.
Well, they haven't.
They haven't changed the rates. Yeah.
Apologies. But this is what I think is really funny. On the Monday entry, right? CommSec, and we've got it up on the screen there. CommSec said, the average Australian loan, blah blah blah. Look at what the title of the slide is.
Yeah, mortgage debt binge.
Like they're not even going mortgage debt increase, right? if I said to you, I went to the buffet and I binged. You wouldn't be going, oh, that's interesting. You'd be going, so you made a pig of yourself, right? Yeah. Right. So what I'm saying is, you know what I mean? Like they're saying, oh yeah, people are really at the trough when they're borrowing money. To me, that's just like
just funny.
Did someone in senior management go, dude, don't use binge?
Well, they don't care anymore. It's just in your face.
Well, it's probably AI that created the headline anyway. But you know what I mean? Like I just read that and went, that's not exactly the word I'd be using to encourage people to, Yeah, I went on a bender. It's like, oh, okay.
Yeah.
I feel like we talk about this almost every week, right? But we do have a note. And again, I think if you haven't already, jump on our website, subscribe to the week that was, because you're going to get all these articles and it's going to make a lot more sense.
And we've even got pictures.
We do. We've got some pictures on there. But in Monday's entry, we underlined the point that it's not possible for asset prices that depend on borrowing to outrun people's ability to pay that back, right?
Yep.
At least forever. You're going to find that there are, the top few percent of the population are going to be the ones that they might be agitated that things cost more, but it's, it doesn't really
trouble them.
No. Doesn't change the shape of the egg really. But yeah, it's everyone else.
Yep. It grows more and more. And again, this is why we've got to be careful of a debt binge. One thing I can tell you is the growth of debt is not too much of a problem if it's steady, right? If it grows at 1 or 2% per year, that's not a problem because GDP grows at 2 or 3, so therefore it can be paid back within the realms of what's going on. The problem you get is when you get a debt binge where the growth goes up a lot in a short space of time, right? And that's what we've had since COVID, right? If you look at that what do they call that thing? The picture, look at June 20, right? It explodes upwards to June 22. That's the COVID period where Phil Lowe said rates won't be going up until 2024 at the earliest, right?
So
everybody jumped in and bought property, right? And they all went, hey, now's a great time to buy, rates are going to be 2%. We can do that. Now the rates are, as in Tuesday's entry, 4.35. People are going, oh, this is a bit tough, right? And that's the problem, because out of my $2,000 that I get every week, that I committed $1,000, now I've got to commit $1,300, and so I'm short more and more money, of which I can spend in the economy, which creates economic growth. Right? That's the main issue. And because the debt has gone up exponentially, that's created a problem, because you can't grow debt at 6% if GDP is only growing at 3%.
Yeah.
Right? Accounting wise, it's just impossible.
Well, it's been made pretty clear now as well for the foreseeable that rates are not going to be cut. They're going to maintain.
Yeah. Well, I think she said on Tuesday we contemplated a rate rise.
Yeah.
Jesus, can you do you know what I mean? Like,
I'm actually expecting that now, like more so than a cut.
Well, we talked about trying to get inflation under control, and they've got one lever, which is we just keep banging up interest rates until we crush the economy. So, they can't really make it any more obvious, can they?
Yeah.
And that's what I mean. It's a bloody tough one for a lot of people to be in, because the previous guy said, listen, get out there and borrow up big. It's not going to go up for a while. We got out there and we all borrowed up big. Now it's gone, oh, hang on, that wasn't part of the deal. That's the way it works. I think you said
they can't even control it themselves.
Well, I think it's what you said last week, Tom, where you said, what do? Well, you got to sit down and do the numbers and say, okay, we need to have a good hard look at ourselves here. Can we still afford these properties, or if investment properties I'm talking about, right? You like stocks, you look at it and go, well, hang on, do I really need to maybe offload this stock and bring cash back into the portfolio? Like that's what the old boy's doing.
Yeah. Do I have a reserve of cash there if I get made redundant, or get laid off, or if unemployment rises and I'm a casualty, are we living week to week?
Yeah. Mm-hmm. You can't look out into the future and go, oh my God, here's a huge hurricane coming. Oh, it'll be all right. I'll just drive straight into it.
It might miss us.
Yeah, it might be a little bit bumpy, but it should be all right. You really want to go, how big's the hurricane? It's big. Okay, well, I need to maybe dodge this. Right, and that maybe means I need to turn the car around and start heading back to where I was.
Yeah. Speaking of cars, EVs, China, Wednesday's input. We've been saying this for a while. We don't have a photo on this one, do we? No. Obviously, globalization is over, and there's dwindling sales of EVs across the world.
Yeah. It's, again, this is what we're talking about with Apple, right? The Chinese are now not buying foreign cars, right? And the foreign car owners, companies, GM and Ford and Toyota and stuff, have gone, oh, this is a bit of a problem. We've put a bucket ton of money into China to get them to build cars, and now they're not buying our cars. But, look, as I said, I'm old enough to see that the Japanese did the same thing. They're not interested in free trade. They don't want our goddamn cars. They want to build cars for us. That's the way they operate. And, to be quite honest, with China, it's the same thing. Why should they buy our cars? They should build their own cars because they've got bloody 1.4 billion people.
Well, it's most of the countries that build their own cars want to export anyway. Same Germany, they're exporting their Beamers and their Mercedes everywhere else. It's not exclusive to China, but it's more of the national security issue that we've been talking about for a while with China, of the data that they're collecting from the things that they're selling to other countries. Yeah,
my argument, Jacob, is it's different now because when we imported a Toyota Corolla in the 1980s, didn't matter. It landed on the shore and the Toyota crew went, yep, good, thanks, see you later, right? There's a big difference now. The reason why is because when your Chinese car lands in here, they can access the data. I wonder where Tom's driving to. Oh, look at that. Tom every Monday morning drives here and goes there. And when you extrapolate that out, the thing that everybody wants is data, because then you can say, this is the way Tom lives his life, and here's how we can sell him some products, right? Tom doesn't drive his car a lot in winter. Oh, I wonder if we offered him seat warmers remotely, whether he'd whether that'd get him to drive his car. Right? Oh, well, there's a guy like Tom who drives his car in winter. Why? Because he pays $5 a month for the seat warmers to be on. Oh, right, okay.
You're gonna have seat warmers popping up on Facebook now.
Well, I don't know, but it's crazy, like you can remote. I freak out because Tesla can remotely control your car.
Yeah.
Right. I get BMW writing to me going, your car's ready for a service. Your car's, due for a service. It's like, how do you bloody well know? Because they've got a computer and that's the way it works these days. It's just really weird.
Because it's been 12 months.
Yeah.
Right?
Well,
they have a calendar.
I was going to say that.
Yeah, but it's like YouTube channel. Here's videos you like. How do you know what I like? Hello.
They know before you know, mate.
Well, that's what I mean. That's why it's different this time, because you can't say to China, oh, well, if you build in Mexico, we'll accept the cars from Mexico, because they're still Chinese owned. And what China's doing at the moment is running into places like Thailand and Vietnam and investing, right, to get around the US sanctions. Well, the next step will be the US says, we're not doing, we're not taking them if they're Chinese built, because the Chinese Communist Party gets access to the data.
Mm-hmm.
Yeah. So we'll continue to see dwindling sales, most likely.
Well, it's going to be an issue, Jacob, for countries that don't want other countries to access the data.
Yeah.
Mind you, the amount of BYDs that I'm seeing popping up is
There's a lot.
outrageous.
Because we've got a free market in automobiles.
Yeah.
Right? So we don't build them. So therefore we just say, yeah, well, if you want to come in and sell cars here, no worries.
Bring the cheap ones in.
Well, bring anything you like in, which is the way it's supposed to work, right? But the Chinese, the Chinese can build 45 million vehicles.
It's the monopoly thing, right?
The market is about 20 million. Okay, so they got 25 million cars that they need to build and export. And if they don't, well, they got an unemployment problem. That's why the cars are insanely cheap, because the governments are subsidising them. That's why the Europeans have gone to the Chinese and said, hey, listen, you guys, you got to stop doing that, right? Because you're now ruining our car market. And the Chinese have, boned up and said, well, hang on a second, we're not doing that. We're just playing by the field. It's like, guys, this is exactly the way it happens.
Yeah, which is actually a nice segue onto Thursday. You've posted an article there about China's real estate downturn. It's, still full steam ahead. Property prices are still dropping despite a big effort to support the property market.
Yeah.
Right?
It's, down 20% in a year or so.
It's
and
down.
continuing.
Well, the 100 biggest real estate companies fell 20% from a year earlier.
Right.
But the point being really that it's just worth rethinking the idea that Albo or the RBA can avoid falling property prices.
Absolutely.
If China can't avoid it, then Australia can't avoid it.
If China, when people say they won't let it fall, my argument is, fine, tell me how. Don't just give me a blanket statement, oh, they won't let it fall. Okay, give me the detail. How are they not going to let it fall?
Well, the detail is immigration and supply and demand.
This is what I keep getting back to in terms of the price. Right? I can give you a legitimate argument about population growth. No problem. Accept it 100%. Right? But are you going to buy a property if it's $5 million? Right? If the bank says, no, Tom, we're not giving you money because you don't earn enough. Mate, you can have 100 million Chinese run into Australia, but the argument is they can't stop that. They can try to stem the flow, but at some point, individuals say, listen, we've got to sell this, because particularly if it's negatively geared, right? Because you are losing money on purpose, and once the capital gain falls away, you go, well, hang on, are we going to lose money for the next 20 years?
Unless, of course, the people who can't afford it have to sell to people who can afford it.
Well,
the inflows keep coming, well, that's obviously what's been happening.
Well, yeah,
or started to happen.
Yes, but again, it can't go on forever. Right? This is what the US discovered. You run out of people to lend to. Now, the alternative for Australia is to say, all right, well, we sell every goddamn residential overpriced property to the Chinese. Mate, their property prices have fallen. So they're not going to be sitting there going, oh, ours is going down. Oh, let's buy those ones in Australia.
Yeah, they're not flush with cash.
Well, it's not big. It's not big enough to sustain a whole market.
Yeah.
Yeah.
Right. And we're just trying to get across to people this idea that, someone's going to come in and save everybody from losing money.
Yeah. We're not saying that there isn't a supply and demand issue. We're not saying that there isn't an issue with immigration. We're saying that the banks will stop lending eventually.
Well, yes, they run out of people to lend to. And some people say, like we're seeing now, I cannot afford a property. Now, the only way the bank will lend to those people is by lowering their lending standards. We asked Tom for 20 grand. He hasn't got 20, he's got 10. Okay, well, let's give him a loan anyway. Then you run out of Toms and then you go, oh, Jesus, Jacob's only got 5 grand. Okay, well, let's lower that and extend the life of the loan from a 20-year loan to a 40-year loan, right? So Jacob then goes, oh, I can afford it. I can afford to pay $4 million for a Sydney property. Well, it stops at some point, right?
There was some word
just
about
before that, Jacob,
loans or something.
Can you go back a step?
Well, that's the alternative, right?
Yeah.
What's that? Yeah, there is. They're talking about 40 or 50-year loans in Canada.
Jeez. Well,
just have a look at that thing on the right, right? This is what I mean about, it'll never fall that much.
Yeah.
Right? In 2006, the building sold for $332 million. Now, 2006 is the top of the bubble, right, in the US, right?
This is in New York City, yeah.
Yesterday, right, 2024, it sold for $8.5 million. That's a loss of $324.5 million.
ugh.
Oh, yeah, but property never goes down. Okay, best of luck, right? That's what happens. Right, you look at that, and there's stocks as well. There was one, I can't remember what it was, but it's gone down like 98%, and you think, but it happens quite regularly when you get, the next slide, which is when you get market bubbles, right?
It happens more often in stocks, and I suppose it's easier to see because you're looking at a chart and you can say, oh, look at all these ones that have been through a bubble. Real estate, it's bricks and mortar, so it doesn't really add up in people's minds that it happens.
Well,
you don't see that on the chart.
It's tangible.
Yeah.
Right? You can drive past it and go, I own that. Stocks are just like some nebulous concept that's on a computer.
Yeah.
Right?
Yeah,
and
absolutely.
it just seems safer to have a property than it does stocks.
Well, yeah, you can't raise your family in a stock.
Yeah.
We'll try.
But that's why, this is what I love John Kenneth Galbraith, really great economist. Once a boom is well started, it can't be arrested. It can only be collapsed, right? And so that's what I'm trying to get across to people, that bubbles don't, subside generally slowly, right? And if you look at Japan and China now, China will probably end up doing what Japan did, which is just deflating it as slow as possible. But that murders your economic growth rate, right? Whereas America said this, right? No, just collapse it and then we'll rebuild it.
Get on with it.
Yep, let's everybody leverage up again and, we'll write off bad debts. Yep, everyone back to normal. Righto, Jacob, get out there and borrow another $1 million and, run a business or buy a property.
20 years.
Yeah, absolutely. Yeah. Absolutely. It's just, it's just the way it works. What else have we got?
We got bonus section, CBA home loan rental payments. If you think renting's hard, spare a thought for some mortgage holders. Which we talked about last week. And at the end of the day, it's difficult for everyone. Tenants don't want to pay more rent, but the landlord has to pay the mortgage, and often the mortgage is more expensive than the rent.
Absolutely.
So there's a deficit of every week or every month that the landlord is out of pocket. So
that's what I mean. It's
easy to blame the landlords, but in a lot of cases,
no one's at fault, really. Yeah. It's just a collective fuckery.
Yeah.
Yeah, it's just the way, this is the problem with the government not building social housing, where they used to say, Tom, you're too poor to own a private rental property. We will put you in social housing. Right? When I was a kid, it was called Housing Commission. Right? Two of my aunties.
Council houses in the UK.
Yeah. Two of my aunties lived in Housing Commission houses, right? Because they were really poor and they had lots of kids. right? So the government said, right, well, there's a house, and listen, give us $20 a week, right, out of your welfare check at 210. When the government went out of that, and they did it the same thing they did in the UK, the poor people had to go into the private rental market, which pushed up the price of property because then there was a shortage of houses. Right? So, the way it works is it's like, oh, well, I can now get 500 for this place, not 450, because I've got all these people lining up wanting to get in there. Right? Whereas before it was like, well, Tom's not there. Why not? Because he's in a government house. So you didn't pressure the market, right? Whereas now you do. And so that's why I think it's become really, really difficult. Right? So, and that's what I mean. I can tell you politically, you're looking at that going, oh man, if I help renters, the landlord's going to, give me a clip across the ear. And if I help landlords, the renters are going to give me a clip across the ear. Like politically, you're looking at it and going, what a nightmare.
Or you start building more social housing, which decreases
the pressure on
which lowers price of the houses as well.
Yep.
Because there's more available.
Yeah, and then the landlords go, hey, what do you think you're doing?
Yeah, exactly.
Right, and the renters go, this is great. I used to pay $450, now I pay $390, and the landlord's going, hang on, it went from $900 to $800.
Yeah.
Right, in terms of capital value.
Yeah.
So that's why they don't say we want cheap housing. They say we want affordable housing. Because if you said to me as a landlord, oh, listen, Steve, we're going to knock the value off of your property, I'd be going, hang on a sport. I'm not voting for you.
100%.
All right. Well, longest period of
the predicament.
Longest period of negative real returns from 1900 to 2023. That's the last chart of the session, and what it's basically showing is what maximum number of years. Denmark's over at 15. So basically, people are piling into bonds.
Well, no, what I'm trying to show there is the longest period of negative real returns. When you hear stuff like, oh, stocks always go up, and when you hear property always goes up, it's like, no.
Yeah.
So if you have a look at, you guys' eyes are better than mine, what's Australia there? 16, is that?
16, yeah.
16.
Right. So for 16 years, and I think you'll find that's from 2007, right? Our stocks of real returns have been terrible.
Yeah.
Right? Now, real returns means inflation and fees and stuff, right? So none of the bullshit of like nominal 8%, right? Because as I said, the RBA did a study in 2019. It's there for people to Google it if they want. And it was a nominal of 8%. A real return, geometric return, which is what we talk about, of 6. Inflation at 4.1 average leaves you 1.9% real. Okay? Rule of 72, let's make it 2%, right? Rule of 72. 36 years to double your money. That's not kicking it out of the ballpark. And people will say, oh, yeah, but there's dividends and dollar cost averaging. It's like, yeah, I know about that. That's why we talk to people about CAPE and say, just hang on to your cash and wait till you can get 10 or 12. Right? That's all the old boy does. Sell Apple, made a ton of money. Right, now I'm sitting here and I'm going to wait for I'm going to wait for the next crash. And he'll buy something, it'll be insanely cheap. The old bugger will die, and in 5 years we'll be going, the old bastard, he's made more money again.
It was right.
Well, he's now buying commodities, Occidental Petroleum, right? All the stuff we've been talking about in the new normal, right? New times coming, folks. You've got to change the portfolio.
Well, on that,
there's another told you so.
If you want the new normal and to look at the 4Cs document that Steve made, head to the website. You can download it for free, and it might make it a little bit more sense there.
Proudly sponsored by Tool Model Management. now back to the podcast.
Well, we might wrap it up there.
What about the chart?
We've done them.
We've done the charts.
We have not.
We did. Oh, no, we haven't.
Chow.
You blokes.
The chow.
The chow.
Oh, this is just about US manufacturing capacity starting to rise, which is what we've been talking about for weeks.
Yep.
Everything going back into the US from offshore, which, look, it should boost the economy.
Absolutely.
But it's not an overnight thing, though. Like, they've started to. This is the start of the next 10 or 15 years.
Absolutely. 100%.
So, but that's all the chart's showing, right?
Just a final told you so.
Yeah,
before we
maybe.
close it off?
Yeah, well, somebody's got to do it. Righto, that's enough.
All right.
That's
We'll
enough
see
boasting
you-
for the week.
We'll see you gents next week, huh?
Yes.
Cheers.
Sounds good.
Cheers.
Thank you.
Bye.
See you, folks.
Stay up to date on our socials. Just search for Total Money Management on Instagram and TikTok. For your free investor personality assessment, go to totalmoneymanagement.com.au. And as always, remember, we don't provide financial advice.